Welcome to the daily update, where I'll go over the action in the market for Wednesday, July 30th, and we'll see how things look for Thursday, July 31st. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. All right, well, the Fed came, the Fed went. Doesn't look like they're really going to have a rate cut in September. The market didn't like that. Of course, President Trump doesn't like that. But they didn't change rates either. And so the market gyrated a little bit after the announcement was made and ended up closing lower. But we haven't had much of a move in quite a while, either up or down more than 1%. We're losing some of the short-term positive momentum. We don't really have a very long list now. We've been drifting lower. We're seeing some internal weakness. Now, on the positive side, after the close on Wednesday, Microsoft and Meta came out with their earnings, and they were both very good, and they're being received very well. And about 7-8 hours before the market opens, as I record this, we're up about 1% with the S&P futures. But we want to be careful, and I'll point out some things as I go through the different charts to show you what I'm talking about. Now, we're still positive, but we're not seeing a lot of conviction. We're seeing sentiment start to drop a little bit more. We're coming into a potential more negative seasonal time of the year as we finish out July and go into August and September. All right, so right at the open, we did see some gyration. We had a higher open and prices just chopped above and below the daily pivot, which was set for Wednesday session at 63.81. Then we had the announcement. That's when things really start to matter. Now, we initially saw prices shoot up, and then they immediately reversed and started to go down. They declined below the unchanged level. We went negative. It went below S1 at 63.58. We did find support at S2 at 63.36, and we bounced from that. We got back above S1, and we closed it at right around the 63.60 level. So we're still under that 6,400 level that the market's already been having some issues dealing with. We'll see if that carries over into Thursday. We were down just 0.12%. So it was quite a wide move for the day, but by the time we closed, we're just not seeing really big moves one way or the other, either up or down on a percentage basis. We were above average with volume, so it did pick up, and we're still positive on all time frames, short, intermediate, and long term, but we're seeing some weakness coming into the short term, as I mentioned, and I'll show you the charts of that. We're seeing a little bit of a deterioration in the intermediate term. Long term is still looking pretty good. Okay, some comments. Earnings have been taken as optimistic, and as I said, Microsoft and Meta, they're up pretty solid after hours. Lots of percentage gains there. Now, Microsoft has been performing quite well, and Meta's been one of the better performing of the mega cap stocks, so maybe that'll help shift things around. Then, during the press conference, Fed Chair Powell, the comments that he said, he didn't really go into this, okay, we're not going to cut rates now, but he didn't hint or really say that they're going to do it in September. And the market was counting on that, and that's why we saw the move down later on. So the Fed ended up leaving rates unchanged. That was not a surprise. I know people think they should have been lowered, but the market, we have to pay attention to what is the market saying. And I look at the Fed Watch tool, and that's been pretty accurate as far as what the Fed ends up actually doing. They didn't cut them, but something interesting happened. And I've been talking about this off and on as these statements are made. Fed Governors Waller and Bauman, they came out recently and said that they would favor a rate cut. And this was the first time that we saw some dissension going back to 1993. That's not usually how it works. Usually they have a unanimous decision one way or the other. And then during the press conference, Fed Chair Powell said that large rate cuts are unlikely. And this is what's keeping it together, the labor market. We've been getting still pretty solid employment data. We're going to get even more on Thursday and the big report on Friday. And if that still looks strong, it's like, why are we going to cut rates? Employment seems to be hanging in there fairly strong, and the economy is not showing signs of being held back by this more restrictive policy. Now, there's a lot of people that would disagree with that, but this is the decision that has been made by the FOMC, and so the market has to go with that. There was a trade deal. I saw a headline saying that South Korea has now made a trade deal with the U.S. We're coming up closer to that August 1st deadline. In fact, that'll be Friday. And growth had a pretty good day, did outperform value. We're still holding up there. Now, even though we're losing some of the positive momentum, we're still looking positive in the bigger picture. We're still seeing a more risk on offensive rather than defensive market. But as we shift over into the new month and to a typical time that is quite often weaker, well, that's what we'll be watching. Is this just going to be a normal pullback before we reset things at lower levels and then get a chance to go up from there as we go into the fall of 2025? That's what we'll be looking at, see if there's a characteristic shift or if things are still holding up fairly well and just getting set then once things have found some kind of a base to move up out of that. Now, we don't even know if that's going to happen. We could just go on the heels of what Microsoft and Meta reported and just screech to the upside, get that short-term momentum back positive, and just keep going from there. There's nothing to say that things have to decline, but historically, that's what we're working from. Then we have a pretty short list right now in the short term. The stochastics are still showing extreme readings, and we're still extreme with the slope oscillator, even though it's negative. It's still below its moving average. Also, a lot shorter list here in the intermediate term with the momentum oscillators there. We're just kind of drifting sideways, slightly negative for the most part. The Sean trend meter it's not really extreme. It's coming down. It's still looking positive, but it has been dropping. And then the bullish percent index for the NASDAQ 100, that's still looking pretty well. And we're not too far away from the 20 period moving average, but we're still far away from the 50 period moving average. And that's what the boom indicator measures. No changes here. They're still kind of like wait and see. You know, a lot of the projections that folks thought about when the Liberation Day was announced back in the spring, all of that is pretty much proven to not be true. That's not how things are working out to this point. Now, things can always change going forward, but again, I don't forecast. We just look at the data that we have right now, and it's looking like the economy is doing well. We had GDP come in, which I'll go over in just a moment here. The economic reports have been holding up fairly well. Inflation seems to be fairly under control. We're not bouncing all over the place and really going sky high with interest rates as well. So things are still looking pretty positive. So the Fed is pretty much concluded now. It's like, why do we need to change anything? Things seem to be doing okay as they are. The dollar is up. Now we are getting a bounce out of that. And if that continues to go up, that could put some pressure on stocks. As stocks were coming up out of the lows, for of course, all 2025, the dollar's not been doing very well. But the dollar going down, that has helped stocks go up. And now that it's going up, we'll see if that influences stocks to go down. And interest rates, actually, they were up here. That's a mistake here. We did go back up to 4.38% with the 10-year yield, where we had been at 4.33%. Sentiment, we're still positive there, but we're ticking down. The context of this is now we're starting to drop. We got up to that 75 level and even went above that. And now, finally, it's starting to come back down. So the context is that sentiment is lessening. And then we are still positive with the trend, and we are trending. And so we're above 20, we're above the moving average, and the bias with the down day, we're negative there. And I'm keeping our momentum at mixed because we're losing some of that momentum that we had been seeing. Okay, so we got the weekly MBA mortgage applications. We get that every week. That's why it's called the weekly MBA mortgage applications index. It was down 3.8% in the latest reading. Last week it was up 0.8%. This just kind of blew everything out of the water. Now, if you remember back a month ago, this came in negative, that there were actually jobs that were lost. And folks were like, well, okay. And then we had the employment report after that, and that looked pretty solid. All right, what are we going to see here? We came in with 104,000 new jobs, much more than the 78,000 that were expected. So that's looking pretty solid there. Then we had GDP, the first time we're seeing the second quarter number. If you remember, first quarter we were negative for GDP, so now we're coming back in positive. You have to have 2 quarters back to back to be what is considered a recession. That doesn't appear to be happening right now. And then the other charts that we look at to also see if we're in a recession, those charts are still looking fine as well. But GDP was up 3%, more than the 2.5% that was expected. Last time it was down 0.5%. This is also good news here, the deflator. This is the inflation component. Came in less than expected at 2%. They thought it was going to be at 2.6%. Last time it was at 3.8%. So according to this, we're actually seeing inflation really coming down. So you kind of got the best of both worlds here. GDP is going up, but inflation is going down. And at least according to the ADP employment change, there's more jobs that are being created. Pending home sales, they were down 0.8%. They expected them to be up 0.4%. Last time they were up 1.8%. All right, so here are some charts. First, the mortgage applications did decline from the latest reading. ADP employment change, it was negative. Now it switched back to positive and showed a pretty healthy move up. Now we look at GDP, and this is quarter over quarter, where we're going up with the blue line. That's GDP itself, where the deflator is going down. I mean, that's what you really want in a more positive environment. Year over year with personal consumption, a little bit bouncing up above zero, so people are still consuming things on a yearly basis. And net exports continue to be less negative than they were before. Then on a year over year basis, we're still looking pretty solid here with real GDP, which takes inflation into account. That's what real means. And then year over year home sales, the pending home sales, actually declining. And again, we've got housing prices that continue to go up. Interest rates are much higher than where they were before. Even though we're not skyrocketing with interest rates, it's making a big difference with mortgage payments. And then you combine that with a much more expensive home, and it's harder to sell them. All right, so then here. Now, this was before the Fed made their announcement here. The real investment advice coming out with forward and trailing operating earnings per share. So if you look at the red, these are trailing, and that usually is a little bit higher. And I go over this in the weekend video in the intermarket analysis. We look at historical PE ratios based on historical earnings, and then we look forward as well. And then looking on the forward estimates here, still we're above that 20 level. We use a 10, 15, 20 point scale. And then we can see the red dash line and the black dash line here. These are the averages. And so we're well above that. But we've known this, and we've been expensive for many years now. So it's not like you can use this as a timing mechanism. You can point this out and say, okay, the market's expensive, but then we start to really go up and earnings seem to be solid, and we get even more expensive. Then median monthly flow into equity mutual funds. It usually is positive into July, but it backs off. And then that's when we start seeing money coming out of the market is in August. So that could put some pressure on the market once we drift over into the month of August. And then, of course, you got all the folks that are making their forecasts where this is at the beginning of the year, and then we had Liberation Day announced. Everybody went down as the market was going down, and now they're going back up as the market's been going back up. So this is just a reaction to what price is actually doing. And then we get this. This also shows how the market is overvalued here. 23.2 when you look at the U.S., compared to the PE ratios across the rest of the world. Then the probability of a US recession in the next year, where Bloomberg has it at about 35%, where Goldman Sachs is at 30%. And then looking here at the market implied probability at 16%. So the market is not expecting that we're going to go into a recession. The percentages are quite low. Then healthcare. Now, there's been some interest in this because healthcare has just been getting rattled around. And it's like, man, there's some good companies in there. They seem to be consistent. You have to have healthcare. Even if the economy falls off a cliff, people still need hospitals and doctors and medication and all that stuff. And so we're seeing some money coming back into healthcare. It's really it's been underperforming the S&P, but it's been hanging in there okay as far as a sector. And I go over that in the intermarket analysis video over the weekend. And so some folks might be deciding to try to get in here, especially if we head into that weaker time in August and September, because these stocks tend to do well. The defensive stocks or the growth stocks, people may be taking some profits on those. And then with low volatility and trend signals strong, systematic strategies. Okay. And I try to explain this very simply every time we get this chart. Systematic strategies just mean you follow a system. You're not really paying attention to the market. When we're down, you're saying, okay, I'm putting my money into the market and it's buying more, a form of dollar cost averaging. And you just hang with it according to a basic system. Where discretionary, it's like, okay, maybe you use some charts, maybe you use a moving average crossover system, maybe you use your emotions or your hunches. And so there are times when you get in and you get out of the market, which when we were really coming down the green line, that holds up better because people are like, uh-oh, we're falling off a cliff here. I better get out. Where the systematic approach took more of a hit. But now that we're going back up and seeing more of a consistent climb, the systematic approach has now been outperforming. And then the year-to-date intraday returns, they reindex them back to 2024. Okay. So this is just, again, showing how a lot of the gains lately, when we were going down, we would see a lot of the losses that would take place while the futures market was open, which was what we call overnight trading. And then we would gap lower a lot there and then see some weakness after that. As we've been coming up out of those April lows, we've been seeing the futures more subdued, and a lot of the gains are actually starting to come while the market is open. And social media sentiment has surged. All right, well, good for them. So this is the Goldman Sachs Sentiment Index that way. And I don't know, if you get your sentiment from social media, you might want to consider some different sources there. And then some other charts. So far this year, AI capital expenditures, that's CapEx, which we define as information processing equipment and software. It's added more to GDP than consumer spending. That's what they're showing here on this particular chart. Then also CapEx. A lot of this is just companies are dumping money back in for AI, and a lot of the big companies like Alphabet, Amazon, Microsoft, Meta. And you can see how these companies are really putting that money back in. AI is the next big thing, and it's been the next big thing for quite a while, and it's really growing. And so companies are really trying to take advantage of that. And then young, unprofitable companies account for just 1% of the market cap, well below the level seen during the dot-com boom. Well, we had massive companies that were young, unprofitable companies. Their stocks would be $300 a share, and here are people standing with boxes in an office space that they just rented, and they have no earnings. They haven't even set up a place to do any work, and yet their stock goes public, and they're millionaires. At least they were for a very short period of time, and then those stocks eventually went down to zero. So according to this, because we have been seeing an increase in speculative investing. And so this chart just kind of says, well, okay, yeah, it's going up a little bit here, but it's not as crazy as it was during the whole dot-com boom. And systematics showing Citadel Scott Rubner, well, good for him, argues that systematic funds have plenty of firepower left. This kind of goes hand in hand with that previous chart and will likely keep going if volatility stays subdued. Well, okay, that's a big if, because if we start to decline and the VIX starts to go back up, That kind of blows this whole scenario out of the water. He warns that systematic positioning could max out in September. Okay, well, look into his crystal ball and see what he says. And maybe vulnerable to any downside shot. Okay. All right. This is kind of speaking out of both sides of the mouth at the same time. We could go up or we could go down. Right now, we've been going back up here with the systematic approach. And then quiet strength. This is what we've been seeing. The internals have really been improving here. They call them regimes. And right now, we're in the most bullish one, quiet and strong. And that's where we just see the market just kind of chop its way higher and higher. Now, it hasn't done that the last couple of days, and it's gone 25 straight days, according to this, without either a plus or minus 1% move. 30 straight days of net new highs. That's not luck, that's trend confirmation. And that's why I look at those charts and talk about them and look at them every day. If you look at both of these charts, we've been much more positive, and this is more internal. This gives us some clues as to what's happening inside of the S&P. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, here is the chart. We did have a positive open. We were above the dashed line, and we went above the daily pivot, below the daily pivot. We found a little bit of support here at the unchanged level, and then went back above the daily pivot, then kind of settled down. Then there was an initial bump going up right when the Fed made their announcement. And then they have to wait around for, I don't know if he crosses the street or goes to another building, but Jerome Powell had to go do his press conference. And then as he started talking, then it's like, where's September? Where's the rate cut clue in September? Not here, not here. We're going down, 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 down. But then we finally found some support at S2. We did bounce back up off of that. So the market was able to recapture a lot of the gains that were given up during the day, or losses, recaptured those losses. And we're up pretty strong now. You put Microsoft and Meta together, and they both are having well-received earnings reports. That's looking well in the initial overnight session. We are seeing growth outperforming value here. The blue line's above the red line intraday. That's positive. We're going up again here. This is looking solid with the growth to value ratio. So even though we had a down day, even though we're seeing some internal weakness, these areas are still holding up quite well. End of day, growth was up, value was down. It was down less for the mid caps and down less for the small caps. So we're still kind of range bound here with small cap growth to value and not really doing all that much with the index itself, but this is still positive. And we are breaking out a little bit, and we're seeing now a golden cross with the mid cap index. We just have the small caps. The micro caps have already done it. All the other major indexes have now seen a golden cross, which means we're now in an uptrend. It's just small caps haven't done that yet. But the growth to value ratio here is looking good. Also looking good with the S&P growth to value ratio coming back up, setting a new high with this growth to value ratio. Doing okay with discretionary to staples. We're still in an uptrend, but we're not seeing a lot of breakout here. The condition of the trend, we're a little bit concerned because we're seeing the green line really coming down, and we're starting to drop below the moving average in the short term. That would mean that we're seeing a weakening trend, and with the green line going down, although it's positive, that could suggest things are getting weaker there. Now, we could recover from this. We could have a good up day and see the green line go back up. We could still go above 40. This is just a dashed line. It doesn't mean we have to really stop there. It's just we pay more attention to this when we get above the dashed line, if we even get there this time. And we're dropping off here in the intermediate term, rolling over, but still above the moving average in the intermediate term. We were above average with volume, so we have 2 days now with little tiny histograms green showing that we were above average. Sentiment, we're still below 20 and coming down on a closing basis with the VIX, also staying below the moving averages. We did spike up there a little bit when the market was really going down, but we came back down with the VIX by the time the market closed. Because this is another thing that we want to keep an eye on. As we get into August, this is when the VIX has a tendency to go up. And that's usually meaning that stocks are going down. Now, we could defy that. We defied that last year. I mean, we kind of had more of a quicker decline, and then we ended up seeing some improvement after that. So it doesn't mean we have to stick to this. This is just typically what happens. And we're coming back up to the moving average here with the VIX of the VIX, both with the bar chart, and we're a little bit below it here on a closing basis with the line chart. And now we have the skew index. So you got people piling back into options, most likely call options here. It could be that. So we're back up into the red area after we had come down from that red area. So the market's still expecting some kind of a big move. But this hasn't spiked yet. When this comes up and then starts to come back down, that's when we call it a spike. And we increased a little bit with this fear gauge. We also increased with this other fear gauge. There's some confirmation of some fear coming back in. We did tick up a little bit with the put call ratio on the daily side. So maybe some folks are buying some puts in the anticipation that we might decline. But still going up with the 5-day chart and the 10-day chart. So this is more negative. When these ratios are going up, that means there's more puts than calls that are being purchased. We're still going up here though. Risk on to risk off, it was up over 1%. This is positive for the market. And the low beta, it's not back to this previous high, just said a few days ago, but the high beta versus low beta, that is going up as well. And we're still declining with the value to tech ratio. When this is going down, that is positive. We're still getting a very high reading here. So this is anticipating some fear that we're not necessarily seeing in some of our other volatility gauges like the VIX. This is really seeing quite a high reading with the volatility risk premium. Advanced decline line, we did decline based on price and volume, but taken together, still looking fairly solid. We're well above advancing moving averages. We did decline, but still above zero with the short and intermediate term advanced decline ratio. We did decline, but still above zero with the 10-day advanced decline oscillator. And we saw more new highs than what we saw on the previous day. Bit of an expansion of the new lows, rolling over a little bit, but not quite crossing below the moving average with the 5-day chart. We're still going up with the 10-day moving average chart. And we are declining, but still above the moving average in the bigger picture with accumulation distribution, but the boom indicator is declining. So bigger picture positive, shorter term with the negative divergence here is where we're going up. This was going down. That's more negative. Short term, we're also declining with the chicken money flow, with the red line going down, and we continue to decline with the chicken oscillator. So this is some under the surface smart money. They're actually doing some selling right now. And we are declining, but still positive with the vortex with the green line above the red line. This is the apples to oranges comparison here with the S&P going up. We're actually seeing a bit more weakness coming in with the red line, which is the NYSE advanced decline line. And even though we're declining here, we're still above advancing moving averages across all the major indexes. We're dropping below zero here in the short term with those stocks in the S&P above their 20-period moving average. So that's actually turning negative now. We are declining, but still above 50 with the 50-period moving average steady. The 100-period moving average steady declined, as also the 200. And so we're just wondering, are we starting to develop something here? We're not really hitting much in the way of overhead resistance as far as pivot points. There's another one that I'll point out later that's on a weekly chart. But we were seeing this series of higher highs and higher lows for the most part. We might be starting to lose that. This is hard to see as we already have the pivot points on here for August. And on the bottom, we were above average with volume. So we're declining with the 20, 50, and 200-day moving averages. But all of these are still above 50. That's kind of the line between positive and negative. And we're no longer extreme and actually dropping below the midpoint with the Stochk RSI. We're no longer extreme and coming down with the Williams percent R. The CCI 14 chart is declining and the CCI 20 chart just barely no longer extreme positive. We are coming down and looking more negative in the short term, rolling over but still extreme, but below the moving average in the intermediate short term, still positive and not quite crossing below the moving average with the long short term stochastic. So this is where the weakness is coming in that we're seeing. And we're below the midpoint with the force index. It's still positive, but it is declining. And you can see these Keltner bands here. They're getting pretty close to each other. And when it's like winding a spring. When they get really close together, we're going to see some kind of a break. But we don't know how long this is going to last before that break comes. Are we going to break back to the upside or are we going to break to the downside? Condition of the short-term trend based on 20 periods, still looking good, but spending a little bit more time underneath both of these lines now that are right on top of each other. That also shows that we slowed down since the lines aren't spread out. And if we stay below this, then these lines may start to roll over as well. We're no longer extreme with the standard deviations chart. We've come back down into the +2 standard deviation channel. Now we switch over to the intermediate term. We're really coming down with the balance of power. And I've been trying to point this out. As we've been going up with the S&P, we've been going down with the balance of power. That's a negative divergence. We're right at 0, so it hasn't technically turned negative yet, but the context is that it's been getting weaker. Still positive with the go, no go, darker blue bars, still coming off of the highest high value and above the midpoint, and still getting kind of long here. 62 trading sessions now that we've been in an uptrend. That's quite a long period of time, but we're still positive even when measured by the proper order. Another negative divergence, going up with the S&P, going down with the TTM squeeze, and the TTM squeeze is actually negative. Still just trailing along, barely above 0 here with the ease of movement. No longer extreme. We turned down just a little bit with the Arun as we saw the buyers dropping off and the sellers pretty low here, but it's mainly the buyers coming out is what caused this oscillator to go down a little bit, even though it's still positive. And we're further below 0 and declining with the S&P McClellan oscillator, so we're going down with the summation index based on price and volume. This is part of the weakness that we're seeing. Also a little bit weaker even, we're further below 0 with the NYSE McClellan oscillator. So the summation index based on price and volume for the NYSE is continuing to decline. That's broader market weakness we're seeing there. Dropping below the midpoint here with the Swindler trading oscillator based on price, and we're just a little bit below the midpoint here based on volume. That's negative. And here's PMO just hanging out, extreme positive, dropping a little bit further below its moving average. When we break it out based on price and volume, we are looking a little more negative. We're dropping further below the moving average based on price and volume, and we're dropping below 50 with the PMOs that are rising. We also drop below 50 with the buy signal, so that's switching over more negative. Still getting a high reading, even though it's declining here with the PMOs that are above 0, that are inside the S&P. Still neutral with the Elder's Impulse system for the S&P, still positive with the parabolic SAR, and still negative here in the short term with the slope oscillator. Even though it's extreme, since it's above this green line, it's still below its moving average. We were starting to see some improvement with the MACD, which is short to intermediate term. It's now turning back down more below its moving average. So still seeing a bit of a divergence here. We're flat to more negative with the slope oscillator since it's below its moving average. Where the other short-term oscillator, it's rolling over here, but still above its moving average. So these aren't confirming each other. Then we look at the 3 intermediate term ones, and they're just kind of flat right on top. Also, the long-term oscillators are starting to drift a little bit lower now, the TRIX and KST. Still negative. We didn't cross back above the red line with the Copic curve. We are declining into this other green area with the Sean trend meter. Declining but above 50 with the money flow. We actually ticked up a little bit with the ultimate oscillator. It's positive since it's still above 50. We did decline, but we're above the advancing moving average with on-balance volume. And we're dropping. We're no longer extreme with the intermediate and short-term RSI. They're coming down. This is official overbought signals that have been triggered now. And we are coming down here, but we're finding support here at the 10-day simple moving average. So this is still holding up, and all the lines are still going up as well. Intermediate term trend looking pretty good here, but now we're just in between the red line and the blue line. If we start to drop down, these lines may roll over, but that hasn't happened yet. This is still looking pretty solid above all the plotted moving averages. And as I've been trying to point out here, going back to May when we finally broke higher here, all of this has been happening above a 20-period moving average. And we're not too far away, or not extreme far away, from the 20-period moving average as measured by the boom indicator, but we're still far away from the 50-period moving average. We're declining below the moving average here with the bullish percent index, so the context here is that's negative. Also declining with the NYSE bullish percent index, and no longer, I should have taken that off the list, we're not extreme with the NASDAQ 100 bullish percent index. That also saw a decline. This is the long-term overhead resistance that I want to point out. This is a weekly chart of the S&P, If we do get an upthrust from those earnings and at least a solid open, we're going to be watching this 64.68 level here. It's hard to see, but I rounded up. So it's 64.67, 64.68. If we hit that level, be watching that. See if that's going to provide some overhead resistance. Now, if we break through that and close above it, then okay. That's just going to show that the market is getting its strength back. And we're looking a little weaker here with our trend studies, the Heikin-Ashi. We're seeing a black candle here, and we're black but pointing down now with the Kegi chart, but the Renko chart is still positive, and we're seeing some really softening here. It's positive with the three-line break chart, but we're not seeing any really big bars lately. Long term, we're no longer extreme with the 150 moving average study, and it's coming back down a little bit. We're also declining, but still quite positive with the 200-day moving average study. Still positive on all time frames with all the different indexes, and bonds are positive in the short term. Commodities, this is potentially some inflationary pressures. They're positive on all time frames. And now we have the dollar back in a short-term uptrend. And we saw utilities communication. So utilities typically more defensive. And as I say, you could make that as a growth area because of AI and electric vehicles and the need for utilities so much, but that did quite well. Communication ended up being up and tech. So two growth areas ended up being up. And then all the rest of the sectors ended up being down with materials getting hit the most. And if you hear a cat in the background, I apologize. So the euro is actually seeing some weakness now compared to the dollar, where the NASDAQ went above 21.1 and then eventually got above 21.2. And Canada, another all-time high there. Staples, this is actually positive for the market when we see a bearish MACD cross over to the downside. And then we had a BPI cross below 70 with the industrial sector. So some weakness coming in there. And so the growth areas held up okay. Now Apple was down over 1%. Microsoft was up just a little bit. I think it was up 8. I forget the actual percentage. Meta was up. One of them was up like 11% after hours. The other one was up 8%. And I forget which one was which, and that's probably changed since I saw it. Nvidia, that's where some of the strength came into the tech sector, where we had both Amazon and Tesla slightly lower. Google was up, Meta was down, but it's up a lot in after hours. And a lot of red over here in the staples area. And still an awful lot of red with real estate and materials as well. And the Dow just kind of chopping along sideways here. It was down 0.38%, and we've actually switched over to negative with the diamonds with the Elder's Impulse system. And also this, we didn't quite hit this for the NASDAQ, this overhead pivot point here. Is that going to produce some kind of a problem? Or if we have a nice upward move on Thursday, are we going to hit this resistance level potentially? And we're still neutral with the Elder's Impulse system for the NASDAQ. Also, we have a ways to go to get back to this pivot point up here. But this is still a pretty good looking chart. The NASDAQ 100 was actually up 0.16%, but still neutral when we look at the cues for the Elder's Impulse system. But the momentum, bit of a negative divergence. We've been going up with the NASDAQ 100. The PPO has been going down. Still dealing with this long-term trend line. We're getting a little bit further above it now. And we're just wondering if when we got about to this line is when things started to slow down. We're still barely above the 200-day moving average with the S&P 600 small caps and getting close with the Russell 2000 small caps. We're not quite there with a golden cross yet. Still above both of the moving averages, even though we were down over 0.5% here. And we're negative with the small caps when looking at the Elder's Impulse system. Golden cross time here for the mid caps. They've hung out above both of these moving averages long enough to generate a positive uptrend, but neutral with the Elder's Impulse system. The Wilshire ended up being down slightly, but still in an uptrend. Also down just a little bit with the total U.S. stock ETF, but in an uptrend there. Financial sector was down slightly, still well above its 50-day moving average. But this is what we've been concerned about. The financials have been continuing to underperform the S&P. They cannot seem to get back above the 200-day moving average. And this 50-period moving average, it's coming down. And if we don't get back up pretty quick, this is going to generate a death cross with this ratio. We want the financial sector to be strong. FANG index, it was up 0.22%, still hanging in there, looking pretty solid there. Apple was down over 1%, and we had Amazon down 0.35%, still in an uptrend. Microsoft, it's gonna now right here when it really gapped up, this was the last time they reported earnings, and they just kept doing really good after that. So that's positive for the market. If we can see Microsoft continue to go up here, and Google is in an uptrend. It was up 0.4%, coming down to the 50-day moving average with Meta, but it's probably going to bounce up significant, at least at the open on Thursday. Nvidia is in an uptrend, up over 2%, setting a new all-time high. And Tesla still kind of mingling around its moving averages. It was down 0.67%. Netflix finally saw a little bit of a bounce here. We fell under the 50-day moving average. Now it gained back 1.32%. And the Dow Jones Semiconductor Index, new all-time high here. That's positive for the market. The SMH Semiconductor ETF, new all-time high there. That's good. So we look at the ratio after it had been declining, and I was trying to point this out while it was happening. It looks like maybe things could be improving now with this ratio going back up. And the semiconductors to Dow ratio also is continuing to go up. But we want to know these things when they're showing some weakness, and then if they do switch back like what we're seeing here, we make note of that as well. We're not trying to predict anything. We're just looking at the current conditions of the market. We're still going down with the staples to tech ratio. That's positive. And dropping off a little bit when we look at US versus world stocks on a short-term basis, we're leveling out with the longer-term correlation. Oil was up 1.5%. We're getting to 70 now. That might start to bite into gas prices. And we're getting closer. We're almost back up to 100 now with the US dollar index. We're still in a downtrend, but we're really getting above that 50-day moving average. And the latest reading from Truflation, 2.04%, which is kind of strange. It's showing this going down, and yesterday it was at 2.01%. Okay, go figure. All right, and we're going back up here with interest rates, but we're still well below this 4.5% level with the 10-year yield. And we came down with the 10-year based on price. Still looking pretty good here with the Q to SPY ratio. Not looking all that good here with the discretionary to SPY ratio. Still looking good when we look at large cap growth versus value on that ratio. So we're above the moving average with the large caps, mid caps, and small caps. So that's looking good there still. And we're continuing to decline with the staples to S&P ratio. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So what's the outlook? We still, throughout the week, are seeing 38% of S&P 500 companies reporting earnings. We're still positive, we're trending, but now some weakness is starting to come in here, and I have that noted later in the conclusion. We will get initial jobless claims as well as continuing claims on Thursday, and then the big one, personal income and spending, that's going to include the core PCE as well as PCE prices, the employment cost index. The hope is that employees are producing more and bringing in less. Now, that sucks if you're an employee, but it's good if you're a company. And we're also going to get the Chicago PMI, which is more regional in focus. And then anything geopolitical that's happening, we'll see. We're coming up to that August 1st deadline. Are there going to be more trade deals that are announced? Is the market going to take them as positive or negative? If more deals are not reached, is the market going to take that as positive or as negative? Are they going to even care? All right, and then Friday we're going to get the big employment report, and also another pretty big employment or economic report will be the ISM manufacturing as well as consumer sentiment. And here's a look at Thursday's economic calendar. Seasonality, we're negative for the Dow for July 31st, going back to 2002. We're neutral to negative with the S&P and NASDAQ. But we see a little bit of a pop here when we just look at post-election years. That's the green dashed line. So a little bit of a contradiction there on a seasonal basis. We're finishing up the second half of July. And also, according to Carson, going back to 1950, we do see a little bit of a pop as we start to finish out the month of July here. But then S&P performance in August, the second term of post-election years, this is a broken up second term for President Trump, but that usually doesn't do very good in August. It hasn't been positive at all with a negative return. Then here's some newer charts just showing how the summer rally is the weakest of all. And you look at here, but they're still positive. And there are times when we've gone up quite healthily in August. Healthily? Is that a real word? And then here is the calendar for August. I haven't started marking this up yet because we haven't started in August yet, but we might see a little bit of a bounce here for the first trading day or so, and then we see some weakness as we go more into the middle part of August, try to bounce, and then kind of this is not very good from a seasonal perspective. So just be aware of that, but we could always go against it. And then we are down more than up. So when you look at August going back to 1950 during a post-election year, up 8 out of 18 times, down 10 out of 18 times with an average return of minus 1.2%. All right, so our three smart money indicators are still looking more negative. Now, the bigger picture is accumulation distribution is still above the moving average, but the boom indicator is declining. Chicken money flow and oscillator are negative, though. Both of those are declining. We're also negative with the S&P and NYC McClellan oscillators and summation indexes. Swell and trading oscillators going down, and now the 20-period moving average study, those stocks in the S&P above their 20-period moving average, that dropped below 50. The bullish percent index, we're going down below the moving average with the BPI for the S&P. And our oscillators, I'm keeping them on the negative side just because we're drifting at best, and even in the short term, we're seeing a divergence there, a contradiction. And the momentum for the NASDAQ 100 is negative. And then the long-term special K chart, which I show over the weekend, that continues to be negative. And I haven't been showing this chart either because it's very long-term and it hasn't changed. The Zohorchak method is still on a full sell signal. Positive side, though, still looking good with our growth to value and discretionary to staples ratios. Parabolic SAR is positive. The bullish percent indexes, now I don't put moving averages on those. And so since they're above 50, I'm counting those as positive. Ease of movement, money flow, and ultimate oscillator are all still positive there. The vortex is positive, but showing some weakness. The financial sector doing good by itself, but underperforming the S&P. And here are the pivot points for Thursday's session. So our conclusion, the only thing I've added here is that we're seeing some weakness coming in the short term. We lost that positive momentum that we've been seeing, even though we're positive since we're still above the 20-period moving average. But we're seeing things deteriorate a little bit. We'll see if we can get that back. Or is this the beginning of seeing even more weakness developing going forward? Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.